We are living in a very strange period of history, not loud like apocalyptic movies, not collapsing overnight, but slow burning enough that almost everyone feels uneasy, even if not everyone can name that feeling correctly. Regional wars and conflicts erupt continuously, no longer distant news on a map. Currency wars unfold more quietly, but far more ruthlessly. Trade wars are no longer threats, they have become familiar weapons. Supply chains break, restructure, and shift. The world is gradually being divided again into power blocks, each side building its own walls to protect its interests. And in the middle of all this, there is something that spreads faster than any virus: fear. Fear does not need a concrete shape. It can simply be the uneasy feeling when you open the news in the morning, the discomfort when prices keep rising, the vague anxiety about the future, about money, about what you are holding on to. When fear spreads, people always do one very instinctive thing. They look for shelter, not because they truly understand the market, not because they have a long-term strategy, but simply because they need a sense of safety. And for hundreds of years, precious metals, especially gold, have been seen as a familiar refuge. Not because gold is good, but because gold is not a promise made by any government. It cannot be printed. It cannot be diluted by a political decision. As long as fear is large enough, capital will automatically flow into gold. No calls needed, no complex analysis required. But this is exactly where many traders and investors begin to make mistakes. They see gold rising and they believe gold can only go up. They hear the safe haven narrative and they believe buying equals safety. They see the crowd pouring money in and they believe they are standing on the right side. History does not think that way. During periods of major instability, gold has never moved in a straight line. It does not just go up. It always goes through brutal cleansing phases, violent shakeouts strong enough to wipe out the accounts of those who believed they were holding a safe asset. The 2011-2012 period is a classic example. When sovereign debt crises, global instability, and widespread fear peaked, gold also peaked. And immediately after came a decline that very few anticipated, not because gold lost its value, but because liquidity was sufficient. Crowd belief was sufficient, and large capital had enough reason to exit. The issue is not whether there will be a massacre. Markets always have massacres. The only question is, from which price level does it start, and at what moment does it happen? The real danger is not in price collapsing. It lies in the fact that most participants never believe it can happen right when they step in. The harsh truth is this: wealth has never belonged to the majority, and markets were never designed to please the crowd. Gold or silver prices rising are, in essence, just reflections of external economic instability. But at the same time, they also reflect the instability inside the minds of investors and traders. Every strong bullish candle triggers greed. Every pullback tightens fear. And most losing decisions do not come from wrong analysis, but from unstable psychological states when facing volatility. Yet everything you see on the screen is only the surface. What matters more lies beneath. The market makers. The flows of capital large enough to decide when the market should rise, and when it needs to teach the crowd a lesson. None of us can know exactly the price level at which they will act. No indicator warns in advance. No news arrives early enough. There is only one sign, and it repeats throughout history. When liquidity is sufficient, when volume reaches the level they need to distribute, action happens. And this is where the market begins to reveal its true nature. The crowd never enters based on logic. They enter because of stories, narratives, collective emotion, economic instability, war spreading, currency devaluation, global crisis. Gold is a safe haven. All of these are true, but the trap lies here. Being right on the macro level does not mean being right on timing. The market does not pay those who are right about the story. It only pays those who are right about timing and risk management. The crowd always enters when the story is already obvious, when the media talks the most, when social networks overflow with forecasts, when experts appear everywhere with charts and long-term targets, when belief turns into collective emotion. That is exactly when risk is highest, because the market does not operate on moral logic. It does not care who is right or wrong, who is well-intentioned or foolish, who is poor or rich. The market operates on liquidity. Where there is liquidity, there is opportunity for large capital to act. Where there is a crowd, there is massive liquidity supply. And here is a truth that is very hard to accept. The crowd is not the winner. The crowd is fuel. Every market buy order from the crowd is liquidity for someone else to exit. Every FOMO move is a brick building the top. Every collective belief is a layer of liquidity. What is called a safe haven on the chart is often a safe distribution zone for large capital, not because they are evil, but because that is how markets survive. And when you look back at history, you will see a frighteningly repetitive pattern: instability, fear, safe haven flows, price rise, media praise, crowd FOMO, thick liquidity, distribution, cleansing. This cycle does not require war. It does not require crisis. It is the psychological structure of the market. The problem is, 95% of participants always appear in the second half of the cycle. They do not come when fear is small. They come when fear has been legitimized, when it has a story, a reason, logic, analysis. And at that point, they believe they are following a major trend. In reality, many are simply following the psychological top. This is where trading psychology becomes most dangerous. Not because you do not understand the market, but because you think you do. You read macro data, you understand monetary narratives, you see the safe haven logic, you have reasonable reasons to buy, but you fail to see one thing. You are not the capital that decides. You are capital that reacts. And in markets, those who react are always at a disadvantage. Most traders and investors do not lose because they lack knowledge. They lose because they stand in the wrong position within the liquidity flow. They buy where others need to sell. They sell where others need to buy. They act when emotions peak, and then they call it bad luck. The market is a scam. The market is illogical. While the truth is cold, the market does not need your logic. It only needs your liquidity. And this is where the concept of safe haven begins to reveal its other face. Safety does not lie in the asset. It does not lie in gold. It does not lie in silver. It does not lie in any symbol. True safety lies in your risk structure. Someone buying gold on full margin is no safer than someone trading crypto without leverage. Someone holding a safe asset without capital management is just as fragile as any FOMO trader, because what kills accounts is not the asset type. It is risk size. And if you look a little deeper, you will see a bitter paradox. Those who talk the most about safety often manage risk the worst. Those who talk the most about safe havens often place the biggest bets. Those who talk the most about long-term often cannot endure drawdowns. That is psychological compensation, talking to reassure themselves. Those who truly survive long-term are very quiet. They do not need grand stories. They do not need narratives. They do not need to be right on the macro level. They need only one thing: survival. Because in trading, survival is the greatest competitive advantage. There is a very common misunderstanding among retail traders. The belief that, if I understand what market makers are doing, if I can read them, if I guess the intentions of big money correctly, then I will win. The truth is the opposite. Only a very small group, about 5%, truly understands the full operating structure of markets. They do not just see price, they see capital flows, positions, liquidity, and points where the crowd is forced to react. But that is not our game. The rest of us, including you and me, do not have access to real data. We do not know real positions. We do not know hidden volume. We do not know who is trapped where. And the most dangerous thing is this: many retail traders refuse to accept that. They spend years trying to guess market makers. They draw complex scenarios. They assign intention to every candle. They believe every spike is a trap designed specifically for them. But the market has no time to care about individuals. It reacts only to volume and liquidity. When you try to stand above the market, you forget the only thing you actually control: yourself. This is where very few people dare to look directly. Retail traders do not need to know what market makers think. Retail traders do not need to guess what they will do next. Retail traders do not need to beat them. Retail traders need only one thing: not to be crushed by them. And the only way not to be crushed is not to be smarter, but to stand in the right position. A position where if you are wrong, you can still stay in the game. A position where if the market moves against you, you are not forced to react in panic. A position where you have the right to wait. This is the difference between the elite 5% and the remaining 95%. 5% control capital flow. 95% have their emotions controlled by it. 5% can endure volatility. 95% have their behavior dictated by volatility. 5% do not need to be right all the time. 95% constantly try to be right. And when you must be right, you break every risk management rule. You increase size to recover losses. You move stop losses to give more room. You add positions because the idea is still right. You turn a trading idea into an emotional gamble. All of this comes from one thing: refusing to accept that you do not know. The market does not demand that you know. It only punishes those who pretend they do. And this is where the only true trump card of retail traders appears: risk management. Not technical analysis, not indicators, not patterns, not news. Risk management. Risk management does not make you rich fast. It makes you last. Risk management does not make you feel smart. It makes you less foolish at the most dangerous moments. Risk management does not prevent all losses. It prevents losses you cannot come back from. A trader who understands risk management does not need to be right often. They only need to avoid being wrong too big. A trader who does not understand risk management can be right 78 times in a row and still be finished after one mistake. And in a globally unstable environment where wars, crises, and fear continuously push prices to extreme highs and lows, risk management is no longer a skill. It is a condition for existence. You cannot control wars. You cannot control monetary policy. You cannot control market makers, but you can control how much you lose when you are wrong. And that is the final line between a trader who still has a chance and one who has been eliminated from the game. In the end, when all the fog is cleared, when wars, crises, and instability are stripped away from sensational headlines, what remains in trading does not change. The market context may change. Stories may change color. The main character may be gold, silver, oil, stocks, or anything else. But the psychological structure does not. Fear repeats. Greed appears at the perfect time. The crowd enters when everything seems obvious, and liquidity is still harvested from those who believe they are seeking shelter. There is no absolutely safe asset, only positions that are better controlled than others. There is no certain timing, only the level of risk you accept when entering. There is no strategy that avoids every loss, only risk management that prevents you from dying from one loss. No matter where wars happen, no matter what name crises take, no matter how many power blocks divide the world, no matter whether gold is called a safe haven or not, the final advice remains unchanged: risk management. Risk management is how you tell the market, I don't need to win today. I don't need to be right now. I only need to stay. Risk management is silent discipline amid the noise. It is the refusal to participate when risk is not worth it. It is the ability to stand aside while the crowd rushes in. Because traders do not die from missing an opportunity. They die from entering too early, too big, and too confidently. And there is a bitter truth that most only understand after paying the price. Real opportunities in the market do not come often. But when they do, they come very clearly. And nothing is more brutal than standing before a truly great opportunity, a rare moment where risk is low and reward is high, but your account is empty. Not because you did not see it, not because you did not understand, but because you spent all your capital on earlier moments that only seemed right. So, if everything must be reduced to one single sentence, it is this: do not let the real opportunity arrive when you have no money left. In trading, survival is not a stepping stone to wealth. Survival is the first victory.